Yeah! Turn me up! Turn me up! All right, let me pull up the chat. All right, almost there. So, good morning. How are you? Happy Tuesday. Let's start with our risk poll. What are you trading today? What are you trading today? Very risk on. Risk on. Risk off. Or very risk off. We'll pop that up there. Gut, das gut, ja. Seems like it's time to start, huh? Let me move everything out of the way. Let me move this there. Cool, and we'll get going. So, guten Morgen. Yeah. Welcome to my office. Hello. My name is Wayne. I'm a trader just like you. Today we're going to use TRADARS and Trader's Way, a beautiful combination of a platform that helps you do your analytics and a platform that helps you execute your analytics. How cool is that? And so we're going to do some technical and fundamental analysis. Today we'll go to the Trader's Way MT4 charts, not just do our fast and furious. So we'll take it an extra step. Does that sound good? Of course it sounds good. That being said, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Let's get an update from our Squawk Box.
United States Red Book Index year over year climbed from previous 5.9% to 7.6% in November 28th. Canadian dollar slips as US dollar Canadian dollar edges back above 1.40, Scotiabank.
Futures pointing to initial rebound on Wall Street. Yay!
Australian dollar US dollar gains as Fed rate cut bets weigh on US dollar. Focus on Australian GDP.
Silver, stepping out of gold's shadow, Commerzbank. Gold retreats from 6-week highs with Fed cut bets limiting downside.
Fed, BOJ divergence weighs on market mood.
Gold, well supported also next year, Commerzbank. Yeah, in fact, the rupee, the Indian rupee, is falling. And I said out loud this morning at our earlier webinar that perhaps that is India buying gold. That would, right? That would increase the balance sheet, but as far as holding a gold asset, but they would pay rupee for it. So now they have less rupee, more gold. So the balance sheet is still balanced. But the world has less gold, so the value of gold is high. And the world would have more rupee sitting in the interbanking system, which would devalue it. Interesting. Yeah, totally interesting. ADP in 23 hours. And Aussie GDP in 10 hours. Pretty quiet day. Coolio. We'll take a look at macro risk here. So we look at 51 variables to do this calculation. All you're trying to do is figure out risk on or risk off. For today, this week, this month, in general, and try to line these things up. 51 variables, and here they are, just in case you need to know. They're weighted differently on their impact for risk, but also they're weighted by time, not just impact. So anyways, it's fairly complicated, or should I say sophisticated. And we've been generally quite risk on, but, things have cooled down. Daily shift yesterday was not a good day, huh? It's been a good week, but it was a bad day. What? Okay, so anyways, yesterday was complicated. What can we say? What can we say about that? Yep. So this is why I ask you, are you risk on or risk off? Kind of matters, doesn't it? Let's see where, did you answer it? Am I supposed to receive further details? No, you just log in. Log in, AK. All right, cool. Just go to traders.com. Click login. It'll ask for your email. There's not even a password. Yeah. Super simple. So you are mostly risk on and somewhat risk off. Yeah, okay, that makes sense. And it comes down to how much are you looking backward versus forward. So yesterday was bad. So many of you are thinking, oh, so if yesterday was bad, today is bad. Well, imagine you had a longer term trend that was up. Then you had a short term move down. Does that mean it's over? That now we're bearish? So the trick with trading is finding the price and the time in which it continues back in the initial trend. So one down day or even a few down days doesn't necessarily make the trend down. Okay. So we had a bullish shift in the week and a bearish day. That just might be a dip. You know what I'm talking about? Okay, I'm going to show you. So I'm skipping a whole bunch, by the way. If you need more details, maybe you should just sign up for TRADARS like AK did. We will go to our technical pattern recognition tool, and I'm going to do an extra step. In fact, let me show you what we did this morning. We took some notes this morning about, and this was hours ago, so you're probably already too late. So now we have to do it again. But I looked at yen pairs and dollar pairs. I'm trying to get a macro trade, and that means dollar strength or weakness or yen strength or weakness. And I'm not even looking at cross pairs. I'm just looking for that. And that's I'm filtering it based on, let's say, a bias, and my bias might be seasonal, whatever. Okay. And so I looked at all the different patterns and all the different time frames, isolating just the yen pairs and the dollar pairs. And then I looked at things that I thought might be bullish or might be turning bullish, and I took notes, just copy and paste. So then I have 1, 2, 3, 4, 5, 6, 7. It looks like 7 or 8 different opportunities. These are the things that you pull up on the charts. And then you start doing proper technical analysis. This just says, look at these 8 things, and everything else is probably a waste of your time. Cool, right? Yeah. So we kind of need to do the same process here, and I will show you the variation of that. Okay. So let's do that variation. So we'll do that for euro dollar, just like we do every day on the YouTube, right? Euro dollar, Bitcoin, 10-year T-note, gold, S&P 500. Okay. And only trending patterns, up, down, sideways, or only reversal patterns. So very, very, very select. We have dozens and dozens and dozens of other assets that we could consider. But I want to show you the process, the daily process, okay? So no 15-minute, no 30-minute, no hour, no 4-hour, only daily. And what kind of pattern is this, up, down, or sideways? Sideways. So I can already go hard pass. However, if it breaks up and out, maybe in a day or two, I can do a breakout trade, but then this will no longer be a triangle. So we will remove the triangle from TRADARS and put the new trending pattern, the up trending pattern, not the sideways trending pattern. And so that's the importance of using these radars, is that you might be bullish and you could use this information to try to front run a break, or you wait for this to go away because this is a sideways trend and you look for an up trend to emerge, and then you do further technical analysis. Okay? Or you say, well, you're very bullish and we've been watching this for 7 days, right? And maybe we're kicking off the moving average, which I talked about earlier in the week. So maybe you're on this, or you're interested in being on this. So what you would do is you'd put this in your notes. So let me pull up new notes, new window. Okay. And you can either do just this information. It's hard to do this and run a webinar. All right. So you can do this kind of thing, and that's enough. Or you can also include this as a reminder. But I look at this triangle's range bound. But we're filtering the range bound, current range bound situation with our longer term bullish bias. So you might be aggressive looking in the dip, and you've already looked at this and kicking off the moving average, so it might be in play for you. But anyways, you take the notes, and then you can move on and finish. You go through crypto and stocks, all of that. Or you can just pull that up now. Let's do dollar pivots. Out. And we will do dollar. Oh my God. And we will start this fresh, I guess. Daily confluence bullish. Or should we do, I guess we'll do day trading bullish buys. Okay. And then we'll go to a smaller time. All right. So now you can say, all right, what did the TRADARS pattern radar point out? Potential, okay, sideways with the potential to kick off a moving average and up. So we're like, okay, maybe. Now we do our technical analysis. You want to be a bull, and it's made a higher high. Can you buy at the roll reversal? Okay. Let's do this as 0.1. Try to squeeze this. Okay. Just a generic up on the roll reversal. Now you might say, well, you can measure this and blah, 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 whatever. Okay, point number 2, if you were using moving averages, you would also do the same. Point 3 is if you were using pivot points, you'd be doing this, which is not much different than that. So the thing is, can this potentially turn into something good? Well, this is a 4-hour. Let's look at it from the daily point of view. And this is what TRADARS has spotted for you. Let me draw it. In red, it's highlighted. Oops. Or highlit. Something like that. Let's use a proper. Let's do it properly. Wayne, do it right. That's still not right. Come on, Wayne. Hey, Wayne, I got a new complaint. And then we have green, and it's connected these three. All right. So this is what we saw on the radar. And the question is, how aggressive are you on front running? Well, if you're aggressive, you have all kinds of permission. 4-hour 21, daily pivot point, roll reversal. And so if we get there, then we're at the next stage. So now this pattern on the radar would disappear, and you should know how to trade at this point. You'd probably look for something like this in the following days. And this pattern will go away. So remember, the whole point here of these patterns isn't to put you into a trade. It's just like, hey, Wayne, look, if you happen to be a bull, you might want to check this out. Now, you might be a bear and say, ooh, that'll be interesting. I wonder if it hits 116.5 and comes back around. This is useful for you as well. Don't look at it as a signal. Say, don't look at the smaller time frames. They're not really helpful right now. Take a look at the bigger picture and then do your technical analysis. So look at this and don't worry about the 15-minute chart, because if we're not trending up, if we're trending sideways, well, your 15-minute chart probably is, less reliable because the asset is not trending. What do you think? Pretty good stuff, right? Very good stuff. Incredible. Ninkao poop. All right. So what about our friend Biddy? Is there anything going on in Bitcoin? We've had that big old collapse, right? So let's take a look. Well, Bitcoin had the big collapse, but there's no pattern right now on the high time frames. Only on the shortest time frame, and it's a recovery pattern. 88,000. So right? Let's take a look. How live this is, if I pull up my Bitcoin, let's go to, that's a 15-minute chart. So we'll go here. This was from earlier. We were talking about if it continues down. All right. So we look at this, and 2 or 3 hours ago when I did this setup, okay, this pattern didn't exist yet. Okay, great. So what is this saying? It's saying, well, you probably know Bitcoin's been falling. But notice here around 85, consolidation, breakout, pullback, long and gone. Now, it hasn't created a reversal pattern on all the time frames, but you should also know, if you're trading this asset, you should already know that this is potentially a double bottom scenario. And if you already knew that, well, then hell's bells, this has much more meaning. Yes, you're still supposed to do your work, my friend. But this says, hey, look, it's happening. In fact, it's accelerating. Maybe you should take a look at it. So you would copy this. Again, you could copy the whole thing in your notes. You don't have to. But you could say, all right, I want to look at that later. So the other way to do it is do all your analysis first and then go back and read your notes. So what I did last time is I did this euro dollar and then I just went and did it. The other thing is you can knock these out and then go to your charts. I kind of prefer that actually. But to each his own. Remember, this is your ability to make intelligent and logical decisions about your trading and investing. Because you can't do it randomly and be consistent. So let's continue on and take a look at the treasury market. Is the market flowing in to treasuries or out of treasuries? Well, this is a way of saying, is the Fed going to cut or not? If prices are going up, the market thinks the Fed's going to cut. Prices are coming down, the market thinks the Fed's not going to cut. So right here, right now, prices are coming down. So there's a way to go check that. We can go and look at the Fed Fund futures market. I am building a tool to do this for you in a more simplified fashion. Not simplified like it's less data. It's actually, we're going to pull it from the exact same data source, but let's say simpler to read. How about that? Easier to read, not simpler. Less confusing doesn't mean dumb. So anyways, we look at this and this is daily. We've had some down days, man. Yields have been going up. Is that going to continue? We don't know. Really depends on what you think the market was doing and what you think it will do. So that's called bias. So if it looked like this to you, then what we're going to do, the pattern would suggest you stay in the pattern until you get to the apex, and then we go this way. Okay? Now that's even more true if there's a slope to the triangle, and we call that a wedge or a flag. Well, this is quite sideways. Okay? And it's not happening yet, but once again, you need to know how to trade if you're going to interpret what this means, right? So you should know these very basic, generally accepted patterns. I just have a tool that will go out and look at thousands of charts for you and just pull up the generally accepted patterns that seem to be forming right now. I just save you hours of work. But if you don't know how to trade, well, then it's not incredibly useful if you don't know how to trade. Yeah. Most of you have gone through investorbootcamp.com. That's a service I own. It's $88 a year. But I also give you these patterns, templates, right? And that's a free service, so there's no excuse, basically. Okay, we'll look at gold. So I didn't copy anything because I didn't see on the 10-year T note an obvious up or down trend, and therefore it didn't seem like an amazing opportunity for me. Good to know. I mean, if you think about it, if I'm looking for 20 patterns on 5 time frames, I just analyzed 100 charts, potential opportunities, and they don't exist for me, and that took seconds. 1 second. I'm like, okay, that's not helpful. But you're like, but Wayne, why would I care if I don't trade treasuries? Well, it tells you what the dollar might be doing. It tells you what the stock market might be doing. Okay. And you need to understand those relationships. And we quantify that in our correlation coefficients matrix. So you can say if then. Oh, if that is happening, then this other thing might happen or usually happens. Anyways, let's get on with gold. We all like gold, right? And gold on a 15-minute chart is trying to breach higher. And this is what I talked about earlier this morning. Earlier this morning, we were here and going this way. The pattern suggests C might lead to D. Not that it will, but that is a pattern that is forming. Okay? However, another way of looking at it is through the lens of a bullish bias. Okay? What if B goes all the way back to A? And that's what I talked about earlier. And then we looked at the Indian rupee, or we got the headline news of the Indian rupee collapsing, and that's where I'm like, I wonder if the Central Bank of India is actually buying gold, pushing gold up and the rupee down. Okay. If we are risk on, why would gold be pushing the high of the day? LOL. Flip from a bearish daily. I'm not sure what you're saying, but there's two reasons to buy gold, right? One to hedge inflation. Another one is related to aggregate demand. Okay. So if we'll take a look at it this way. If the Fed cuts interest rates in the next, we'll say between now and the end of the first quarter. So in the next 4 months, we have at least 2 meetings, right? At least. There might be a third squeezed in there. Okay? I don't know if you're looking at it wrong, and I'm not here to tell you right or wrong. Let's just talk about it. Okay, Kosick? All right. Kosick, in your humble opinion, what's the percentage? Now, I'm looking for a percentage from you, and everyone can give their percentage too. In the next 4 months, which is 2 to 3 Fed meetings, what is the probability of the Fed cutting interest rates? At least once. Potentially 2 or 3 times. But just at least once. Feel free to answer, everybody. But Kosick, I'm waiting for you. I want a percentage number. I'm not looking for high. I'm looking for a precise percentage number. You're so funny. I'll give you a 99% chance, but 100. Okay, yeah. All right. Okay, cool. Then, if you are correct with your ginormous guess of 99%, what is the impact of that cut on the value of the U.S. dollar? Okay, U.S. Well, don't worry about gold. Gold doesn't have to do anything. Gold is gold. Dollar changes value. Okay, what is likely to happen to mortgage rates? Okay. Is that good for the real estate market or bad for the real estate market? Good. What happens to companies like Home Depot and Lowe's? Do sales go up or do sales go down? Okay. If Home Depot and Lowe's report sales going up because of mortgage rates falling and an increase of demand for purchasing existing homes, then what happens to the stock of Home Depots and Lowe's on the stock market? Okay. So if these borrowing costs for mortgages are helpful to consumers, would borrowing costs falling be helpful to small and medium-sized businesses? Would it make them more profitable if their borrowing costs, their cost of doing business falls? Would that be good for them or bad for them? Okay, so now the broad general economy is doing better. Great. So what about non-farm payrolls? If the general economy is improving, what about retail sales? What about the purchases of cars? Oh, financing them gets cheaper. Durable goods. How does it impact that? What about new orders? Industrial capacity and utilization. Okay. So then you say, wow, this is a broad market. Are we hedging inflation? Not necessarily. Getting back to gold, sometimes you buy gold to inflate it to hedge inflation, and that's when inflation is higher than GDP. But sometimes people are just doing good. Sometimes people are just rich. Okay? Sometimes you buy a new gold watch. That's aggregate demand. So if there's a general increase in the stock market and a general increase in the real estate market, everybody is generally better off. They feel more comfortable. They're willing to take risk. They're willing to spend money. And there's an increase in demand for everything, not just gold, but it could be wine. It could be running shoes. It could be stupid hats, but aggregate demand for everything. That's why they call it aggregate demand, not just demand for oil, the demand for everything. So now you want to look at things like, why is the Fed cutting? Because the economy is crashing? Or are rates too high? Who's the benefit? Who's the loser? There's always the why. So inflation's at, let's say, 3%. That's really high. Well, where's GDP? If growth is higher than inflation, you probably have an aggregate demand issue, which creates supply and demand, let's say demand or lack of demand or growing demand for gold. Or if inflation is higher than GDP, then gold might do the exact same thing for a completely different reason. And this is where, these rules of thumb that you hear on YouTube from gurus that don't have decades of experience or even an education in economics and finance, where they just know the rules of thumb, inflation up, buy gold. You know what? That's not always true. Inverted yield curve, the stock market's going to crash. That's not always true. You have to know why it's inverted. Who is inverting? Oh, well, they don't know that. Okay? So I'm not saying you're right or wrong, Kosick, but I do want to thread the needle, put all the pearls in place for you to make an informed decision. Okay? So, for example, let's reverse the whole process. Let's say Indian GDP is down. So, India. I'm not saying it is because I don't track it. Okay? Okay, let's say GDP is down. Oops. Yeah, GDP down. Okay. And you're the Central Bank of India. What do you do? How do you stimulate growth? Because you want GDP up. Cut rates is definitely one. The problem is it's not like you decide to mathematically, you just say, okay, or let's say legally, right, Jim? The central bank, it's not like they just say, we hereby declare interest rates are lower. Well, how do you create more employment? That's a consequence of a monetary policy. So you can typically you need to use your own money to buy bonds. The problem with that is it creates inflation. So the other thing you can do is buy gold, which is not inflationary. And I'll tell you why. Here's your balance sheet at the central bank. Balance sheet. Okay. All right. And, okay. Liabilities, assets, and I won't put bank capital. We don't need that there. Okay. So let's say in India they have 1 billion US dollars of rupee. We'll just call it 1 billion. Okay. And over here they have 1 billion of currency. Balanced. Now, if they bought bonds, the money stays in the country increasing money supply inside the country, creating inflation. Which, even if you get GDP up, inflation erodes it, and all of a sudden you don't really solve anything. All right. So you don't want to do that. So you want to buy something from outside the country. So instead, you buy, okay, this is cash. We'll call this cash. Let's say you take half of your cash, half of the entire assets of the Bank of India. Okay? And you, right? Now you only have $500 million in cash, but then you go into the interbanking system, you put the cash in the interbanking system by converting it into gold. You go out and buy gold internationally. So now the central bank, okay, has 500 million in gold, 500 million in cash. They still add up to 1 billion, but we've removed gold, the cash from the Indian economy, the domestic economy. So that is not inflationary. That's disinflationary. Meanwhile, right, you got to go to the interbanking system now. And the quantity of rupee, what is rupee? Is it like this? Sorry, India. And we'll call the value of rupee. Okay, this is the demand curve. And we will do green as well. That was supposed to be green, everybody. Okay, green as the supply curve. Okay, this is the quantity. 1, 2, 3, 4, 500 million. Okay. And the value of 1, 2, 3, 4, 5. Okay. But this is not rupee domestically. This is not the amount of rupee in the bank. It's not this. It's where did that 500 million US dollars of Indian rupee go? It went into the interbanking system. So now supply is over here. Supply 2. And so let's say that the old equilibrium was here. I know this is 100% accurate because we would have started at 0, 3 would have gone to 8, whatever, just go with it. What I'm showing you is we were at, okay, actually we would call this Q star at equilibrium with the value of 2.5. All right. Now, okay, we're at Q2, which is quantity 2. There's now, right? And then we go across and we're at 1. So the value of the rupee dropped from 2.5 to 1. And that might make things cheaper inside of India, allowing for GDP to go back up, but not impacting inflation inside of India. Okay, because the value of each rupee is significantly less, but there's not more rupee. So if you're like, well, if the value is less, you just pay, let's say, at least double. It's going to be more than double the price, and everything's good. Yeah, but you would need double the money. There isn't double the money. There's actually less money. So prices can't go up. So in this case, this could spur foreign investment. This could spur purchases of Indian products and services from foreigners, because to the foreigner, everything now is at more than half price. And so lots of purchases of Indian products and services happen. Money starts flowing back. Foreign money starts flowing back into rupee and into the economy. Jobs pick up, productivity picks up, output picks up, GDP picks up. Okay? And demand for the rupee picks up, and it stabilizes back at, let's say, at 2. Because now demand will increase, and now you have a double shift, which is indeterminate, but it brings it back closer or to or above where it was. And what you're doing is you're increasing GDP. Now, a government that just simply prints money or buys its own bonds does the opposite. GDP falls, money supply inside the economy shoots up, and inflation goes out of control. And that's what socialism does. So maybe rupee's collapsing and India's buying gold. So is that the truth? I don't know. So why don't you go look at GDP and inflation in India and then think like a central banker? By the way, in Investor Boot Camp, I think it's hour 4 of the monetary policy class. I teach you how to manage the balance sheet of a central bank. Just so you know. All right. And I got to get that Fed presentation done, huh? All right, S&P 500. Are you guys ready? By the way, was this a good webinar? Did you click thumbs up? Did you tell YouTube this is good stuff? Have you signed up to traders.com? Have you opened up your Traders Way account? Thank you, Richard. I'm a great man. Well, maybe I don't know if it makes me great, but it makes my explanations of great. Yeah. I mean, I'm just saying I could be a jerk, but still explain that correctly. But I appreciate it. This is big, heavy, big boy knowledge. I appreciate that. Yeah. All right. So, where are we? Yeah, we're over here, and we are looking at the S&P 500. Very interesting setups here. S&P 500 rising wedge on the hourly. Okay, bullish. It's showing as we get into the apex less and less bullish. Like it's slowing down. It's vulnerable. Okay, then zooming in a little bit more on the 60-minute. This pattern is actually a reversal. Oh, no, which means maybe one possibility is this. Even the higher high creates a lower low. Oh, God. It's not that it's going to, it's just might be forming. The other thing that might be forming is this is a bottom, and we're going to do this. So it's more like, hey, pay attention around X. Okay? Bulls should know this, bears should know this. And then on the 4 hour, yeah, we should be able to get to 69. You know, everyone's trying to get to 7,000. And it's like, yeah, maybe. So this is all like, maybe. Just be careful around 69. Right? Yeah. So anyways, you can put that in there and say, well, what do we think about this? All right. So you can put it in your handy dandy notepad. Do you remember our exercise here? Okay. Okay. And the sum of just these assets that we've gone through today. Now, remember, TRADARS has dozens of assets, individual stocks, global stock indices, a ton of crypto, so on and so forth. So this was just the quick and dirty. You might just be a crypto only dude or dudette. And you're like, I'm a crypto only dudette. Okay, cool. And you might only care about crypto. Cool. And there's a lot going on in crypto. Okay. Does this look like a buy? Nope. Does that 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 look like a buy? Nope. Okay. So we can do whatever you need. But anyways, let's go to Trader's Way and take a look at this S&P. All right. Dow's all over the place. S&P. All right. Zoom out here. Do I need to clean this? Nah. I guess I could. Let's go. We'll drop into a daily confluence from a bullish point. Okay. Okay, that's fine. We'll do that. Notes here. There might be a reversal pattern forming around 69. Butterfly Fibonacci pattern. Okay. Came out at 4 o'clock this morning. Possible bearish price movement, even at a higher high. All right, so let's take a look at it's 60. Where do we see? 68.70. Target 68.70. So one way to do that is pop a horizontal line here, double click it, go to properties, okay, and you say, just copy that. Wait, no. That's going to be a target. That's a okay. So that's what it's talking about. And it's basically a pivot point. I get it. Good. Completely different math, but it makes sense to me. So what it's saying is, okay, let's go back to the general idea of a Gartley. Now, I'm not very good at seeing Gartleys, never have. Okay, so I find it helpful because I'm eyeballing this as a bull and I'm eyeballing this as a bull. Okay, great. And it's saying, hey, even if you get a buy a dip scenario, and that's where we are now, okay, this is plan A. Plan A could lead to a bigger collapse. And then we know if that ends up holding, December could be way lower based on monthly pivot points. Now, I don't think it'd be that drastic, but it could be. Right? We don't know. Oops. So I'm already thinking, okay, plan A from a bullish point of view, plan B from a bullish point of view, and maybe even plan C. Got to do yet another color. Plan C is further down. Okay, so those are my bullish plans. But the Gartley suggests a failure. And the failure would be in here. So do you think I should be hypersensitive up there? Yeah. Okay. It's not that it's going to happen or it has happened. It's just forming. So it's TRADARS is telling you, look, if you're a bull, your risk increases up around there. You should know that. Now, a bear should say, oh, well, if that happens, that creates essentially a double top. And now you could enter your monthly strategy of taking this down, and that December is crazy bearish, ugly bearish. Okay? So it's non-directional. You need to know how to read the tea leaves, my friend. But these tea leaves are organic, picked by monkeys at the top of high altitude mountains. Yeah. And then they're hand rolled and dried inside a cedar shack in front of a great fire. And then shipped to you for your enjoyment. But if you don't know how to make tea, or if you don't know how to read the tea leaves, okay, yeah. So anyways,